Welcome to the Byte-Size Brief. Today we are putting Morgan Stanley, MS, that's MS, completely under the microscope. Let's get into it. I mean, we're talking about an $18 billion quarter, right?
Yeah, it's pretty staggering when you just look at the raw numbers.
Right. And a stock price that just smashed through to an all-time record high of $191.23. But, at the exact same time, they just fired, what, 2,500 people?
Exactly, 2,500, which is why this deep dive is so critical today. We really need to look past that headline euphoria.
Yeah, because normally, you look at a legacy bank and you expect slow, steady, almost boring numbers. But right now, this bank is practically moving like a tech stock.
It really is. And that price action is entirely anchored by a Q4 2025 earnings report that basically rewrote their own history books. I mean, they posted a record full-year earnings per share of $10.21.
Wow.
Yeah, but the metric that institutions are actually obsessing over is their ROTCE.
The return on tangible common equity.
Exactly. Management has been chasing this elusive 20% target for years. And in 2025, they finally crossed it, hitting 21.6%.
Right. And for you listening, if you aren't staring at bank balance sheets all day, ROTCE is basically the ultimate scorecard for a bank's fundamental efficiency. Like, it measures how much profit they're squeezing out of their physical capital. So to break down the mechanics, tangible common equity just means you take the bank's total equity and you strip out all the invisible abstract stuff like goodwill or, brand names.
Yeah, you're just left with the hard, undeniable cash and physical assets.
Exactly. So hitting a 21.6% return means for every real dollar of hard capital sitting in the vault, Morgan Stanley, MS, generated nearly 22 cents of pure profit in a single year.
Which, for a highly regulated, massively complex global bank, is just an astronomical return.
It's insane.
Right, but the magnitude of that return is exactly why we need to objectively examine if CEO Ted Pick's 15-year structural transformation of the firm is truly bulletproof.
Because of the layoffs.
Because of the layoffs, yeah, and some other sudden cracks appearing beneath those record-breaking numbers, we have to figure out if those cracks pose a legitimate threat to regular investors who, might just be tempted to blindly ride this current all-time high.
Right. Well, to really understand why Morgan Stanley is trading at these historic multiples, we have to examine their engine, right? We have to look at their moat.
Definitely. And the foundation of that moat is a fundamental shift in exactly how this company makes its money.
Okay, so walk us through that.
So if we look at the data and rewind to, say, 2010, wealth and asset management made up just 26% of their total revenues.
Just 26.
Yeah. Back then, they were heavily dependent on the wild, unpredictable swings of investment banking and trading. So in a good year, they printed money. In a bad year, revenues just vanished.
Right.
But fast forward to today, under this strategic transformation, wealth and asset management now account for a staggering 54% of total revenues.
So more than half of the entire pie is now shielded from the chaos of the trading floor.
Exactly. That shift creates a highly durable, recurring fee base. They now manage $9.3 trillion in total client assets.
That's a lot of fees.
Yeah, and when you're charging a percentage on $9.3 trillion, the revenue flows in steadily whether the broader stock market is up or down.
Right.
And here's a brand new data point from our sources. Just this month, in March 2026, their wealth management division crossed a historic milestone. They hit $1 trillion in individual retirement account, or IRA, assets alone.
$1 trillion just in IRAs.
Just in IRAs. That specific segment has been growing at a 15.8% compound annual growth rate since 2022. It's entirely outpacing the industry average of 13.6%.
Wow. To visualize how they pull this off, I like to think of the Morgan Stanley MS Wealth funnel as like a Major League Baseball farm system.
Well, that's a good way to look at it.
Yeah, so if you're listening to this and you have company stock options managed through your employer, you're basically already in Morgan Stanley MSAA team. They catch the mass affluent retail investor early through acquisitions like E-Trade, that's their minor league system. They sweep your unused cash into their banks to lend out. They track your net worth. And as you accumulate wealth, maybe you sell some of that company's stock, your portfolio gets more complex, the bank eventually calls you up to the majors and hands you over to a full-service, dedicated financial advisor.
Exactly. And the friction to leave that ecosystem is so high that most people just stay for life.
Right. I mean, it sounds like a flawless, perpetual motion machine. But what's the catch? Nothing goes up forever.
Well, the vulnerability lies in margin compression. Yes, the funnel is highly effective, and in Q4, their wealth management margins hit a very impressive 31.4%.
Okay.
And the firm's stated goal is to maintain a structural 30% margin moving forward. But achieving and sustaining that level of profitability requires incredibly heavy, continuous investment.
Like tech upgrades.
Tech upgrades, exactly. The mechanics of modern wealth management require deploying expensive AI-powered portfolio parsing tools just to stay competitive. And furthermore, you have to pay elite financial advisors top-tier compensation.
Because if you don't pay the advisors their massive cuts, they just walk across the street to a competitor and take their entire book of wealthy clients with them.
Exactly. That dynamic makes advisor compensation a massive, immovable fixed cost. It usually eats up 35 to 40% of those wealth revenues.
Ouch.
Yeah. So if the broader macroeconomic environment turns downward, total client asset values will naturally shrink.
And since the fees are a percentage of those assets, the revenue drops right along with it.
Right. But those high fixed costs for technology infrastructure and elite advisor retention, those do not drop.
Ah.
So that mechanical squeeze could severely threaten their 30% margin target and erode the foundation of their current stock price.
Okay, so compared to last quarter, what actually moved the needle here? Because like I said, a slow and steady wealth management business provides a great safety net, a nice floor, but you don't get explosive sudden stock surges from slow wealth accumulation. Where did that explosive Q4 cash actually come from?
The catalyst was an absolute renaissance in their investment banking division.
Really?
Yeah. The first half of 2025 was notoriously sluggish across the entire financial industry because interest rates were high and corporate deal-making was essentially frozen.
Right, nobody was making moves.
Exactly. But Q4 told a completely different macroeconomic story. As rates stabilized, their investment banking revenue surged 47% year over year.
Wait, 47%?
47%, hitting $2.41 billion in a single quarter.
47% growth in a division of that massive scale is difficult to even comprehend.
It is, and the underlying driver of that surge was their debt underwriting division, which skyrocketed by 93% to $785 million.
Wow.
To understand the mechanics here, when massive corporations need billions of dollars, they don't just take out a standard loan. Morgan Stanley, MS, structures the debt, syndicates it, meaning they slice it up into thousands of pieces, and sells those pieces to institutional investors and pension funds all over the world. They act as the architect and the distributor, collecting an enormous fee for facilitating the capital. We can look at their peers as a benchmark to see how unique this quarter was. Like, Goldman Sachs also had a very robust quarter, primarily driven by traditional mergers and acquisitions. But Morgan Stanley, MS, is separating itself by carving out a massive, highly specific niche. They're becoming the lead financier for the global AI infrastructure build-out.
Oh, wow.
Yeah. For example, they just acted as the lead advisor for Meta's $27 billion debt financing, which is entirely focused on building a new hyperscale data center campus.
Hold on. How does that actually affect Morgan Stanley, MS's stock price? For regular investors like me, does one big tech deal really move the needle? Because I hear Meta data center, and I immediately think about tech stocks, not a legacy bank stock.
Well, it moves the needle because it redefines their role in the global economy. Instead of using the tired picks and shovels gold rush metaphor, think about the company ASML.
The chip equipment guys.
Right. ASML builds the complex microlithography machines that manufacture advanced computer chips. ASML doesn't care whether Google, Meta, or Microsoft wins the AI war. They simply get paid billions to build the arena where the war is fought.
Oh, I see where you're going with this.
Morgan Stanley, MS, is positioning itself as the financial ASML of the AI revolution. These tech companies require unprecedented, capital-intensive infrastructure server farms, secure energy grids, cooling systems.
And they need billions to build them.
Exactly. Morgan Stanley, MS, isn't taking the operational risk of developing the AI models. They're serving as the mandatory, highly profitable toll booth, collecting massive underwriting fees to fund the physical architecture of the future.
That is brilliant. They are taking a massive cut of the biggest economic expansion on the planet without having to write a single line of code.
Exactly.
But okay, if that is the reality, if investment banking is printing money at a 47% growth rate and the wealth management safety net is catching trillions of dollars, why is this firm showing actual undeniable cracks in its foundation?
Because no massive institution is immune to structural weakness.
Yeah.
And our sources point to two major vulnerabilities right now. First, the trading floor has developed a severe split personality.
What do you mean by that?
Well, their equities trading desk is thriving. Revenues jumped 27.8% for the year,
Yeah.
significantly outperforming competitors like Bank of America. They're currently dominating prime brokerage services for hedge funds.
Okay, so equities are up.
Right. Conversely, their FICC division, which stands for Fixed Income, Clearing, and Commodities, is experiencing a steep decline.
Ah, so the bond and currency trading desks.
Yes. While the rest of the industry saw modest growth in that sector, Morgan Stanley, MS Q4 FICC revenue actually dropped by 8.7% year over year.
Ouch. Why the drop?
Mechanically, what happened is that mixed signals from the Federal Reserve created immense rate uncertainty, which effectively paralyzed the fixed income markets. Bond traders just sat on their hands. Meanwhile, sheer FOMO fear of missing out drove explosive retail and institutional volume on the equity side.
Makes sense.
Yeah, so they're lagging far behind their peers in a critical trading segment. And then there's the second major risk, which you alluded to in the introduction, the workforce reduction.
Right.
Despite posting record revenues and hitting an all-time high stock price of $191.23, Morgan Stanley, MS, just laid off 2,500 employees.
Yeah, that's 3% of their entire global workforce.
Exactly. And the cuts span across every single division: investment banking, trading, and wealth management.
And this is where I have to step in and push back on behalf of the everyday worker and the retail investor. Because this is the exact corporate behavior that drives people crazy.
I get that.
You literally just posted an $18 billion quarter. Your CEO is bragging about 21.6% ROTCE. You are structuring $27 billion AI deals for Mark Zuckerberg, and your immediate celebratory next move is to hand out pink slips to 2,500 people.
Wow.
It just feels like ruthless, aggressive cost-cutting just to pad the bottom line by another fraction of a percent to appease Wall Street analysts.
Yeah.
It completely contradicts the narrative that the company's internal health matches its soaring stock price.
Look, the optics of those layoffs are undeniably harsh for the individuals affected. However, from a strictly macroeconomic and financial perspective, shedding human capital and legacy roles is an exercise in proactive capital management.
Wait, proactive capital management is just sanitized Wall Street speak for firing people to buy back your own stock. If Morgan Stanley, MS, is making record unprecedented profits, why not invest that excess capital into retraining those legacy workers to use the new systems rather than just buying off shareholders?
Because the fundamental mechanics of the banking industry are changing. The bank isn't just trimming costs blindly, they are permanently shifting their operational structure.
How so?
Remember that AI financing toll booth we just discussed?
Yeah.
Morgan Stanley, MS, is actively deploying that exact same AI technology internally. They're automating back-office compliance, algorithmic trade execution, and massive-scale data analysis. A machine can parse a 10,000-page regulatory document in seconds. That's a task that previously required a floor of junior analysts. Retraining a junior analyst doesn't change the fact that the role itself is obsolete. Shedding that human capital structurally lowers their long-term efficiency ratio. And generating that excess capital through reorganization gives the board the financial ammunition to return tangible value to you, the investor.
Okay, let's follow that money then. If they're freeing up all this capital by replacing human compliance officers with software and pulling in record underwriting fees, how exactly is that translating into shareholder value as we move through 2026?
Well, it translates immediately into capital return. The board just approved a $1 per share quarterly dividend.
Nice.
That's an 8.1% increase, pushing their annual dividend run rate to $4 a share. On top of that, they authorized a massive multi-year share repurchase program to buy back up to $20 billion of their own stock.
$20 billion.
Yeah. And the reason they can afford to authorize a $20 billion buyback safely is because their balance sheet is completely fortified. Their CET1 ratio, which stands for Common Equity Tier 1, it's the core regulatory measure of a bank's financial strength and ability to withstand a severe stress test, currently sits at a highly secure 15.3%.
What's the requirement?
The Federal Reserve requirement is only 12.6%. That means they have billions of dollars in trapped excess buffer that they are now legally allowed to unleash back into the market.
Which is fascinating when you zoom out and look at the broader economy.
Right.
I mean, I was reading that exact internal Morgan Stanley MS report they put out for 2026, the one warning about a massive AI breakthrough coming later this year. They're predicting models that can work autonomously for an entire 8-hour workday without human intervention. If that actually happens, the entire tech sector is going to experience a secondary explosion. We're going to see software stocks, chip makers, and cloud infrastructure companies ripped to valuations we haven't even conceived of yet. The whole market is going to...
Right, but what does all that actually mean for Morgan Stanley MS investors? We need to ground this back in the specific ticker we are analyzing today.
Fair enough. Reel me in. Considering the AI toll booth, the massive wealth floor, the FICC weakness, and the layoffs, what does the street actually think this stock is fundamentally worth right now?
Well, the analyst community is highly fractured, which is a clear indicator of the current risk profile.
Okay.
On the bullish side, you have firms like KBW, Keefe, Bruyette and Woods. They just set a highly optimistic $210 price target.
Oh, wow.
Their mechanical argument is that the structural changes, specifically achieving that durable 54% wealth management revenue split and hitting the historic 21.6% ROTCE, completely justify a premium valuation. They believe the bank has fundamentally evolved beyond a traditional cyclical trading house.
But obviously, a $210 target means not everyone is buying that premium narrative, considering where it trades today.
Exactly. The broader consensus actually hovers significantly lower, right around the $176 to $194 range.
Okay, so basically right where it is now, or lower.
Yeah. The more cautious analysts are looking at that 47% investment banking surge and warning that the stock's current record high valuation of $191.23 has already fully priced in a perfect M&A supercycle for the rest of 2026.
Right. And priced in basically means the market assumes flawlessly executed deals will continue indefinitely.
Yeah, precisely. If the Federal Reserve unexpectedly shifts interest rate policy, or if antitrust regulators start aggressively blocking these massive tech mergers, that lucrative underwriting pipeline could dry up fast.
Yeah.
If the reality falls even slightly short of perfection, the stock has a long way to fall because the premium is already baked into the price.
So it is a high wire act for investors right now.
Yeah.
You have a juggernaut wealth management floor providing incredible stability and explosive investment banking growth acting as a catalyst.
Yeah.
But underneath that, you have structural cracks in fixed income trading and a workforce going through a painful automated transition.
Which leads us to a broader, arguably more critical question that the market hasn't fully priced in yet.
What's that?
If Morgan Stanley, MS, is effectively becoming the core financier of the global AI infrastructure, underwriting the data centers and energy grids that power the future of technology, what happens if the U.S. government starts treating them not just as a bank, but as critical national security infrastructure?
Oh, wow.
We've seen regulators block tech mergers. It makes you wonder how long until the regulators step in and attempt to dictate who Morgan Stanley MS is legally allowed to finance in the global AI arms race. The regulatory risk of becoming the indispensable toll booth is entirely uncharted territory.
That is a massive variable that could completely rewrite the bull thesis. I mean, not to mention the irony of financing the very AI infrastructure that might eventually cannibalize their own massive workforce, fundamentally changing what it means to be a Wall Street bank.
Exactly.
All right, listeners, what's your take on the future of Morgan Stanley? Are you bullish, bearish, or sitting on the fence? Let us know in the comments. See you next time on the Byte-Size Brief.